Hello everybody, today I'm going to walk you through a quick example of right offerings and how we can price rights. And so rights are really just securities that are going to be issued by the firm to existing shareholders in hopes that they can raise capital from their existing shareholders. So we're going to walk you through a couple different examples of pricing and what rights offers are in this video here. So the first slide you're going to see is what we just said earlier in the introduction slide. These are going to be issued of common stock offered to existing shareholders. So here, a rights offer, like I said, the hopes from the company is that they can raise capital from their existing shareholders. So depending upon the number of shares an investor holds of, let's say, company XYZ, there's usually going to be one right given for each share owned. And with that, an individual, a shareholder, is going to have an opportunity to redeem those rights, and usually a number of rights, for an additional share of equity. And so this is advantageous to existing shareholders because this is going to avoid dilution of potentially their ownership in the firm, because the company can have a couple different ways that they can create capital or raise capital. One would be through potentially a seasoned equity offering, right? So they could go out and they could potentially raise more capital in the public market, but not through current shareholders. They may issue and give the opportunity for others outside the company to now buy these new shares, and this would dilute some of the ownership that existing shareholders would have. And this is sometimes a downturn to existing shareholders, and shareholders may want to avoid this dilution of ownership. So what are rights? Again, we can really think of these rights really in some sense as a call option, right? So we can think of this in some sense as a call option to existing shareholders to give them the right to acquire more shares of the company that they already own. And so a rights offering are going to specify the number of shares that can be purchased. So within the offering, within the contract, they're going to say, hey, each individual investor is usually going to get one right for each share, and then they're going to specify that there's going to be this many rights required for you to acquire one additional new share. Okay, so also within there, they're going to specify the purchase price. So if you want to acquire a new share, this is going to cost you some sort of price per share. In this one, and we're going to tie this back down here, the price specified in the rights are generally less than the current market price. So there's going to be a subscription price that we refer to. This rights subscription price is usually less than what the current market price is. So for example, if the current market price was, let's say, $15 per share in the market, ABC was trading for $15 per share, the rights offering, the price of that right, that subscription price, is going to be somewhere less than 15. Let's say, for example, it would be $14. Why is this the case? Because the company is trying to incentivize existing shareholders to buy and raise capital, right? They want existing shareholders to go out and raise this, to buy new shares, because they're trying to raise capital. If they had the rights offering the subscription price, whether equal to or more than the current market price here, right, on this side over here, if they gave the offer of $16, well, hey, nobody in their right mind would go out and say, yeah, let me acquire new shares at $16 when the current market price would be 15. So if we tie this back to some options terminology, right, we could think about this as an in the money call option, right? It's going to be in the money. There's going to be some sort of value to that. And also with rights, there's going to specify a time frame. Usually the time frame is somewhat shorter than some of the other options we see. If you're familiar with warrants attached to bonds, right? This again is some sort of option that's going to give the bondholder the right to acquire shares in the future. Those are usually very long term. in terms of rights, these are very short because the company is trying to persuade investors to exercise their right in a timely fashion because they need to raise capital. So a lot of times we can see these between 4 to 8 weeks long. Okay, they're really wanting them to really shareholders to move on this incentive to raise some additional capital. So let's walk through some examples and some numerical examples of how a company would potentially understand how many rights that they need to issue in terms of how much money they need to raise, and then the value of rights, right? What is the value of these rights and what investors can do with these rights? So here's an example. Okay, so we have a company here, this company, let's say ABC Corp, they want to raise $5 million. Here's the subscription price, right? So the subscription price is for $10 and the current stock price is now at $11. Okay, so the question is, and right now the firm currently has about 3 million shares outstanding. So again, when we tie this back to the previous slide here, we can see the subscription price is less than the current market price. This is always going to be the case when a company issues their rights. So now we have 3 points here. How many shares have to be issued, right, to raise this $5 million? Okay, so how many shares do I need to raise to acquire this $5 million? How many rights will it take to purchase one share? Okay, so if I get 1 right per share, how many rights am I going to have to purchase 1 share? That's the information I need to pass on to the investor. And then the last one here is, what is the value of the right? Okay, so is the value of the right, $10? Is it 50 cents? We're going to find that out here quickly, okay? So the first question here, how many shares have to be issued? So if we come down here and we see, funds to be raised. Okay, so this is going to equal 5 million, right? So we have $5 million. That's what we need to raise. Okay, so we have the 5 million divided by this subscription price, which is right now what we refer to as $10. So funds to be raised, how many shares are we going to have to raise for that? Well, we're going to have to, sorry, this shouldn't be a dollar sign here. We're going to have to issue and raise about 500,000 shares. So we have to issue 500,000 shares. The next question on here is the number of rights to purchase 1 share. So if I'm going to purchase 1 share, can I purchase 1 share with 1 right, or do I need 10 rights to do that, or did he need 20 rights to do that? How do we get this answer here? This is going to be equal to the 303 million shares outstanding divided by this number here that we just calculated, divided by the 500,000. Okay, so this is going to equal, how many rights do we need to acquire each share? Well, each individual is going to have 6 rights to acquire 1 share. So here we're going to need to raise 500,000 shares to be able to raise this $5 million at the $10 subscription price. Sorry, I had a quick call there. Every time I make one of these videos, it seems like somebody calls me. But so back to where we were and we're leaving off. We need 6 rights to purchase 1 share. And so the next step along here is going to be, now what's the value of the right? So if we go here and we say the value of the right, of 1 right, okay. Now, if we say the value of the right, this is going to equal to, okay, the stock price, the current market price, minus what this subscription rate, okay, so this is the current market price minus what I'm going to refer to as the subscription price, or we can think about this as the exercise price if we think in options terms, divided by n plus 1. And n is simply going to equal the number of rights we need to purchase one additional share. And this +1 here, this is going to be for a period of what we're going to refer to as the XRight period. Okay, the XRight. And so we can kind of, if you're familiar with dividend timeline or the dividend payment time frame, XRight means that, hey, if I'm going to buy these shares, XRight coming with the right, what's the value of these shares? So if this is during the XRight period, this would equal to $11. Okay, so $11 is here. That's the current stock price minus the subscription price, which is $10, over, we need 6 rights to purchase one additional share +1. Okay, and so this is going to come out to be 0.143. So each right that is going to be provided to us is equal to approximately 14 cents. Now, we know, just like if you're familiar with the dividend timeline, these shares are then going to go through a period of XRights. Again, remember, when I'm going to buy these shares, these are going to come with the rights associated with them. So that stock price is going to be embedded with not only the current market value of the shares, but also the value of the rights. Okay, so if we want to calculate now what is the value of these rights in the XRight period, okay, this equation here that we just looked at, okay, so this equation is going to remain the same. The only difference that we're going to do now is it's still going to be S minus X, okay, so this is now again stock price minus the subscription price over, now we're going to drop the +1. This is going to be only N. So if we walk through this example here, okay, so this is going to be during the XRight period. Let me just put it down here, XRight period. So, excuse me, XRight period. This is going to be stock price minus the subscription price over N during the XRight period. This is going to equal now to $10.857. Now, this is key here to remember. This now, the stock price during the XRight period is now going to fall by the amount of what the right was during the XRight period. So now the stock price, instead of being $11, is going to be $10.86, let's say. Okay, so this is approximately 14 cents out of the original stock price minus the subscription price. This is still going to remain the same now. This is still going to be $10. So here, now this is going to be divided by 6, right? There's no +1 period. If we make this calculation, this is now going to turn out to be 0.143. Same value during the XRight period. Now this is the case because here, remember, when these shares go from the XRight period to the XRight period, the value of the share here is going to drop by the value of the rights, and we're going to make that small adjustment to really provide what the rights are during the XRight period and what the value is during the XRight period. So those are some quick examples here we looked at in terms of rights. Now the last slide is just going to outline what we just kind of outlined in during what we refer to during the XRight and XRight period. This simply is just going to highlight XRight. The price of the stock will drop by the value of the right on the day that the stock no longer carries the right. So that's when it goes from the XRight period to the XRight period. Now, what can stockholders or shareholders do with these rights? They can do different things, right? They really have 3 different options. The first option is that they can exercise the right, right? So they can exercise this right and they can go and acquire new additional shares, and they're going to be able to acquire these additional shares usually at a discount to what the current market price is. That's why the rights have value. So that's one way they can exercise or use these rights. Number 2, they can now go sell these rights on the open market. So most rights will trade on the exchange, on the same exchange in which the underlying shares are trading, and so these are going to gain value. They can sell these rights to other existing shareholders. Maybe other existing shareholders want more rights, they want to have the option to buy more shares, or they can sell them to other non-shareholders who want the opportunity to buy shares in company XYZ at some price that's outlined in the rights offering. Or the third option that they currently have is number 3, and I don't have it on the PowerPoint here, is that they can just let these rights expire, right? They can just let these rights expire. They don't have to do anything, right? If they don't want to buy new shares or they want to sell these rights, they can just let these go to waste. Now, this is probably not the most advantageous opportunity, obviously, of the 3. You want to be able to capitalize on the opportunity either to exercise these rights or sell these rights, but those are really the 3 offerings, and so we see many investors do exercise those rights or go on to an exchange and sell those either to an existing shareholder of ABC or some other member of the public. So that's a quick outline of rights offerings. There's some other specifics within the rights that you may be able to acquire from your different textbooks and where you're learning rights offering. But these rights are probably a little bit cheaper. They are cheaper for companies to raise capital than going out in terms of issuing new equity in a seasoned equity offering. And generally, these were a little bit more popular, especially in Canada, during the late 70s and early 80s. But now all of a sudden, these aren't so popular anymore because there's new techniques, new methods to raise capital in terms of bought deals, and so now the rights offerings aren't so popular. But anyways, I hope this kind of helped you understand what right offerings are and some different calculations that correspond to right offerings. If you do have comments, suggestions, please leave them in the comment box below. And as always, if you like the video, please give me a thumbs up and subscribe to my channel. Thank you.